Hi all fellow investors, today we're going to take a closer look at Altria Group, stock ticker MO. If you don't know them, Altria Group is a company that sells smokable and all tobacco products in the United States, and they are primarily known from the Marlboro brand. Altria Group is a company that most people have deemed down and out, but not too long ago they released a press release of their earnings from Q2, and the non-GAAP EPS actually beat estimates. The revenue did miss by a small amount, but the shares went up pre-market when it was announced. And they also reaffirmed their guidance to deliver 2022 full-year adjusted diluted EPS in the range of $4.79 to $4.93, which would represent an adjusted diluted EPS growth of around 4 to 7%. Roughly 1 month later, Altria also declared a 0.94 per share quarterly dividend, which was a 4.4% increase from the prior dividend of $0.9. Over the last year, Altria Group is almost down 14% and is actually trading pretty close to its 52-week low of $41. So let's take a closer look at Altria. Currently, it's trading at a PE non-GAAP forward ratio of 8.89, which is 25% below its 5-year average of around 12. With the current share price, it actually offers a dividend yield of 8.75, a payout ratio around 76%, which is actually pretty good because Altria have said that they aim to have a payout ratio of around 80%. They offer a 5-year growth rate of 7.89, and they have been growing the dividend for over 50 years, making them a dividend king. If we look at the numbers behind, you can actually see on the revenue that Altria Group is growing their revenue. You can see here $19.5 billion in December 17 to $21.1 billion in December 21. And a comment on the whole dual situation, I actually found this, that a Bernstein analyst, Callum Elliott, had commented, and he said, while the dual ICOS Philip Morris situation represents a significant long-term strategic threat, at the present time the sky is not falling. In fact, business rolls on just fine, and Bernstein has a market perform rating on the stock. Jumping back into the financial statement, on the cash flow statement, you can see here that cash from operations are also growing. We had December 2019 as a pretty low amount, I would say, but otherwise you would have a pretty steady cash flow. I would say 8.3, 8.4, 8.3 in the last 12 months, and the capital expenditure is really low. So they're not really using that much money to generate this cash flow, which is really nice for shareholders to see. Jumping into the balance sheet, you can see that the cash and cash equivalents for the last report is around $2.5 billion, which is not that huge. Scrolling down to the total debt, it's a bit high on $27 million, and net debt is not that much lower. They do purchase back a lot of shares. You can see here, just from the December 21 to the last report, is a pretty significant lowering in that amount. So they are bringing back a lot of that free cash flow to the shareholders, both in terms of buying back shares and also by issuing dividend. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And for your own good, please don't skip ahead in this part, as I will share the estimates the models are based on, so it's important to know those to make a decision for yourself. The first one we have here is the Graham's revised valuation model, and as you can see, I put in the EPS from the last earnings call, and I also put in a growth rate of 4.26, which is pretty much in line with the 4 to 7% they gave as guidance for the 4.79. So it's a bit on the conservative end on their guidance for the full year. Also, obviously, the current yield of the AAA corporate bonds we put in as well. The next one is the discounted cash flow analysis, and I have only applied a minor growth rate of 3% because there are a lot of uncertainties with Altria instead of the average growth rate. So I think that's pretty conservative as well. Also, I put a discount rate of 9%, so there should be some room to grow here. For the dividend discount model, I only used a growth rate of 2%, as that is around the lowest it has grown over the last 4 years. So I guess for the coming years, it's conservative enough to say that it will be close enough to this. even though the last one we had was 4.4%. For the multiples valuation, I pretty much compare to other tobacco companies, which makes most sense, and say. And for the last one, we have the free cash flow valuation. I compare the price to free cash flow ratio with the operating cash flow and the free cash flow per share over the last 10 years, giving it an intrinsic value as well. Before we jump into the summary, if you did enjoy this content, please like the video and subscribe to the channel for more videos in the future. And now let's jump right into the summary for Altria Group. As you can see here, we have our 5 valuation models, and the average intrinsic value of those models are $64. With the current price being around $41, the average current discount is 35%. If we apply an additional margin of safety of 30%, then we get the acceptable buy price to be around $45, which is also way above the current price. So even if we apply a higher margin of safety of around 35%, we actually get pretty close to the current price. So at the current price for Altria, if you like the company, I would say there is sufficient safety to enter the stock. So let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. And thank you so much for watching once again, guys, and please don't forget to like and subscribe to the channel.